Hey there, it's Jeff McDermott from Create Wealth Financial Planning, and you may have heard about healthcare savings accounts or HSAs. You may have heard a lot of financial planners like me love them. What makes an HSA a special tool in your financial toolkit? Who are they right for? How can you maximize the value of your HSA? When might they not be a good fit? Will you even have to worry about healthcare costs, or are the AI robots going to be taking care of us in the future? In this video, we're going to break down the value of the HSA and some of the unique features that go along with it. So a healthcare savings account is a special tax-advantaged account that is attached to certain kinds of health insurance plans. Financial planners love them because in general, they are basically the only triple tax-advantaged investment account out there. It's potentially tax-deductible when you contribute. The money is tax-deferred, or it does not create any tax ramifications while the money is in the account. And it's potentially tax-free when the money comes out of the account. They also differ from the similarly named flexible spendings accounts, or FSA, because the HSA is not a use it or lose it kind of account like what the FSA is. It's almost always the first question I get when I suggest somebody consider an HSA who's not familiar with it. What happens if I don't use all the money? Because we have it drilled into our heads that it's the use it or lose it with these healthcare accounts. But the HSA, or the healthcare savings account, does allow you to keep that money year after year, even if you don't use it. There's some limited ability to carry some amounts of the FSA money forward, but not all of it, not like the HSA. So let's compare some of these different tax-deferred account types with the HSA and with the... So if you look at this chart here, we've got traditional IRAs, Roth IRAs, and the two kind of healthcare accounts. Traditional IRAs, tax-deductible as long as you meet certain income rules. Tax-deferred, meaning all the money's in there. There's no 1099s or any sort of taxation while the money's in the IRA, but it's taxable when you take a distribution. So 2 out of 3 on that one. Similar with the Roth IRA, but the reverse. There's no tax deduction when you contribute if you're eligible to make that contribution. It's tax deferred while the money's in there, and it's tax-free if certain conditions are met when you take the distribution. So again, 2 out of 3 with the Roth IRA. The flexible spending account, or the FSA, is tax deductible. It is tax-free when it comes out for healthcare expenses. I didn't check the tax deferred box because, again, you have to use it in the year. There's not really any time in there for us to worry about taxation during the year. But the healthcare savings account, the HSA, it's tax deductible when you contribute. It's tax deferred while the money's in there. And if it comes out for qualified healthcare expenses, tax-free when it comes out. That triple tax advantage. Also, again, comparing the HSA and the FSA, it's that ability to keep unspent money. So if you put $5,000 into an HSA this year, you didn't use a dime of it, you didn't go to the doctor, or you just paid out of pocket for that, all $5,000 rolls into the next year, and so on. And so now there's some other neat things about the HSA as well. A huge missed opportunity for a lot of HSA users, either because they don't know about it or they don't really understand the impact of it, is the ability to invest that money. Just like an IRA or Roth IRA, you can invest a big chunk of your HSA money. Usually there's a cash amount between $500 and $2,000 that your HSA provider might require you keep in cash. But beyond that, you can invest it just like a retirement account or a 401k. Now you have to not spend the money to be able to invest it. So I encourage a lot of families I work with who can afford to pay out of pocket, out of cash flow for regular medical expenses, co-pays, deductibles. Do that. Just pay like you would pay for anything else and leave the money in the HSA to be invested. Investing has risks. You should talk with a professional about having the right investment mix there, but you could potentially turn today's contribution into even more tax-free dollars down the road. To be aware of with the HSA is you have to be in a high-deductible healthcare plan to contribute to it, and that's not going to be for everybody. This is where it really comes down to doing the math and comparing your healthcare options and finding what's right for you. The IRS has a definition of a high-deductible healthcare plan. You can see this chart here. For an individual, it's a minimum annual deductible of $1,650 for 2025 and a maximum out-of-pocket expense of no more than $8,300 for the year. And then family plans are just double those numbers. Minimum deductible of $3,300, max out-of-pocket of a little bit over $16,000. Now, what it really comes down to is doing the math. These high-deductible healthcare plans usually have a lower premium, So you're going to save in premium during the year. You're going to have a little bit higher deductible. You're going to have a higher maximum possible experience. When you compare the lower premium versus the higher out-of-pocket costs, factor in the tax savings, factor in the fact also that many large employers will have an HSA match similar to a 401k. So they might put $1,000 or $2,000 in that HSA for you. That is going to defray costs. I find a lot of so-called high deductible healthcare plans are cheaper in the long run as long as you, the consumer, can handle and weather the higher out-of-pocket costs during the year. So again, it's not going to be for everybody. You have to have probably a little bit of extra cash flow, but it can save you in the long run and it can give you access to this HSA often. Other caveat going back to our chart here, the penalties on non-qualified distributions. Though with traditional and Roth IRAs, a lot of us are familiar with this age 59 and a half rule. If you take money out before 59 and a half, with a few exceptions, you're going to have a 10% penalty. We don't worry about that with the FSA because we have to use that during the year. But with the HSA, it's actually a 20% penalty for non-qualified, non-healthcare related distributions before age 65. So that means it is pretty expensive to put money in the HSA and not use it for healthcare expenses until you get to age 65. And the neat thing there is it's still taxable, but you can use the money for any purpose, just like a supplemental retirement account, just paying income tax on it beyond age 60. A couple other things to think about outside of this chart, limited beneficiary options with the HSA and just the unknown future of healthcare costs. So with an HSA, you can leave that account to your spouse, who can then use it for their healthcare expenses, potentially tax-free. But other beneficiaries like children or other family members will essentially receive a taxable distribution of the HSA money if you pass it on to them. So it's not really a suitable wealth transfer tool. We also don't know what the future of healthcare costs are going to be. I was half kidding earlier about AI robots taking care of us, but the reality is we don't know. Healthcare might be way more expensive in the future as more of our country ages and more of us need healthcare. Might be less expensive if it becomes more efficient and more automated, and it might be about the same. So with both of those, having a plan to eventually spend down the money, that age 65 number of removing the penalty if we find we have too much HSA money or if healthcare costs just aren't as burdensome as they are, is a nice little tool to spend down the HSA if you need to. So those are the ins and outs of HSA accounts. Triple tax advantaged with the ability to invest and grow your money, keeping in mind you have to be in the right kind of health plan, and that plan needs to be a good fit for your family. And it can be expensive to use the money for things other than healthcare, at least before age 65. Reach out if you have questions or you want to review your own healthcare options or your HSA plan, and we will see you in the next